Welcome to View from the Markets. I'm Aline Van Dyne, the US Markets Editor at the Financial Times. And today I'm joined by Joe Saluzzi, co-head of equity trading at Themis, which is an institutional brokerage. Welcome, Joe.
Thank you.
The subject that you have gotten into the spotlight for is high-frequency trading. This is part of the change in the equity markets where computer-generated trading, particularly programs that execute orders at very, very high speed, now by some measures dominate the volumes, the daily volumes in the US equity markets.
Yes.
Let's start by explaining a little bit how we got to this place, or why this came to your attention.
Sure. I think it's very important to actually look at the evolution as to how this really started. And kind of what's going on now is a byproduct of Reg NMS, which was instituted in 2007 by the SEC. The intent of Reg NMS, or one of the intents, was to have more displayed liquidity. So you put it in the quote, you would get your execution. So they were trying not to have all of this hidden liquidity. What we have now is just the opposite. We have dark pools, we have hidden pieces everywhere, and we have algorithms which are always sniffing for other algorithms, and it's this whole kind of mess of electronic fragmentation that exists. And really it is fragmented. The market is not a central limit order book by any means, not that I'm advocating one. But anyway, what happened was investors' computer technology obviously was getting much better, and that's fine because you do need to keep up with the computer technology. Algorithms started going, but the high-frequency trader saw this space and pretty much saw a whole new playground.
And these guys, they're sort of some specialist traders, but also proprietary trading desks at big firms like Goldman Sachs?
It could be from what, again, I've never met a high frequency trader, to be honest with you. I've never talked to one because, they don't really like to talk about these things. They're a bit of a secretive bunch. But it could be a bulge bracket firm, it could be proprietary firms, it could be hedge funds. They have something called sponsored access, where you could be a hedge fund going through a brokerage firm who is sponsoring your access, and there's a whole other story there of whether those are pre-trade controls and so on. So they're going out there and they're now spotting trends and taking advantage of them. Again, nothing wrong here. The problem is that now we've gotten to the point where 70% of the volume, as estimated by some research groups, is high frequency related. So they are commanding a much bigger role in the marketplace, and therefore now the exchanges, who know they are competing for this flow, since Reg NMS they all compete, have to cater to the high-frequency trader. The number one constituent for them is the high-frequency trader, no longer the real institution, like, let's say, Fidelity or T. Rowe or Wellington, the real guys, no longer the large bulge bracket firm, but now the high-frequency trader is the one that says, I want this, you better give it to me or I'm going to go somewhere else.
Well, so for an institutional investor, you might think that you can just type in your order into a computer and sit back and let it kind of automatically execute.
Right.
But you're saying that because of all this high-frequency trading, you actually might, the electronic execution might get sort of diverted by other programs?
That's correct. And you won't even know it, depending on the sophistication of your algorithm. And there's a ton of algorithm providers now. Every bulge bracket, every broker is in the business of providing algorithms. And just as a sidelight, we went to visit a new client once, and we went and pitched our business and what we do, and they looked at us and they said, you're the first guy not to pitch an algorithm to us. You're actually a real person. We're like, yes, we are. The reason why you need people is to not get caught up in these movements like we're talking about. So at the end of the day, the algorithm thinks it did a good job, and we're telling you that if you actually really traded that stock, you could have done a better job. It takes work. That's what you got to do. It's just, people call me an old-fashioned tape reader. Well, I'm using electronics, but I'm using my skill as a trader and my ability that's been developed over years to make sure that I find the liquidity and don't get front-run by somebody else.
But aren't you essentially using your skills in the same way that other people are using their computer skills to do the same thing?
Well, that's an excellent point, and yes, we're using our skills and competing against the computers. We don't have a problem with that. We enjoy the competition. My partners and I welcome the opportunity to compete against the computer because I bet you I can beat you almost every time. However, we have a problem when a computer has advantages at certain computers, let's call it that way, have advantages over other investors, namely co-location, flash order technology, and obviously the rebates. Everyone gets rebates. But let's take two of them, for example. Co-location, well, what is that? We've talked about that in some of the articles. That's when you, the large firm, gets to place your supercomputer next to the New York Stock Exchange's data center, next to NASDAQ's, next to BAT's, whoever the market center may be.
So that the distance is the least, it
Physical,
shaves, what, a nanosecond?
And that's enough.
Right.
That's enough to beat me. In other words, I see 5,000, say I have 5,000 shares on the offering and I want to lift it for my client. I go out and say, I'll buy that. As my order's coming in, they can see me coming and just basically cancel. That's what a flash technology will actually do. So they're using these new methods. So the co-location gets them more speed. The flash, which NASDAQ calls flash, others call bolt or ELP or whatever you want to call it, allows them to see an order as it's coming in before the general market sees it. And more importantly, not just that they will trade in front of it, it's that they will cancel their offerings. And I can't tell you how many times we've seen where there's 1,000 shares offered, and you say it's 100 a lot, and 800 a lot, and 100 behind it, and you try to go lift it, and you end up getting 200 shares. Well, where did the other 800 shares go? It didn't print. It disappeared.
It cancels.
It cancels because they see you coming. So they're not real liquidity.
And when you say they, you mean the
computers.
The computers.
They're not real. So my distinction again between liquidity and volume is very important, because real liquidity, if that 1,000 shares was real, I would have been able to buy that stock. I'm the only buyer, let's just say. And I bet everybody who's ever traded a U.S. equity stock, or for that matter, any stock, because everyone's doing it across all different countries, knows what I'm talking about. They see it all day, they feel it all day, and they just can't quite figure out, like, where'd that go? Where'd that move? So is that an efficient process where people can cancel their offerings and you get no stock in that sense? It's because they see you coming. That's really the inefficiency here.